Hello everyone, since a lot of you were asking me in order to create videos on the topic of finance, this is the first video where I'll be discussing about why is it important to invest in bonds and what proportion of your asset allocation should be invested in bonds. So for those of you who don't know me, I'm Kushal Lodha, a recently qualified chartered accountant with an All India rank 5 in November 2019, and I'm also a CFA level 3 candidate. I've given my CFA level 3 exams in November 21, and I'm also a qualified ACCA, which is Association of Chartered Certified Accountants from the United Kingdom. So in this video, we are going to discuss what exactly is bond investing, how should you invest in bonds, and why is it necessary that we should have at least 10 to 15% of our portfolio allocated to bonds. So let's watch this entire video. So first things first, what are some of the different asset classes? So let's say you are a salaried individual, or maybe you have earned some amount and you want to invest in some asset classes. So there are various asset classes for all of you. One is real estate. Of course, in real estate, you need a huge investment, but now there's a concept of REIT, which is Real Estate Investment Trust, where you can invest small money also in these REITs in order to get exposure to real estate. Of course, we are not getting into technicalities of REITs, but I'm just explaining about some other asset classes. Next is gold, where if you want to hedge against inflation, then you should definitely try investing in gold. The next asset class, which is the most popular asset class amongst all of us, which is equities. You need to invest in the stock markets, and going forward in the future, I'm also going to create some videos on stock markets as well, in terms of what factors I look before investing in any stock and what are some of the stocks or IPOs which are having booming valuations. And the last one is bonds, which is one of the safest investments, and you don't need to worry a lot about your default if you're investing in some good credit rating bonds. Of course, there's fixed deposit also, but I don't recommend anyone to invest their surplus funds in fixed deposit, because if you see, the inflation rate in India is somewhere around 5 to 6%, and even all the fixed deposit rates are somewhere around 4 to 5%. So I think like your real value of money is diminishing if you're investing in fixed deposits. So for example, if the inflation rate is 6% and if you're investing in 5% FD, there's a minus 1% real rate of return which you're getting. That is, you're paying 1% and you're not getting 5%. So you need to understand that. So let's focus on the third asset type, which is the bond market, which is the bond investing. And let's also understand why is it essential for people like us to invest at least 10 to 15% of our proportion in the bond market. So firstly, what is a bond? So if a company wants to borrow money, it has two options. One is debt, other is equity. So bonds fall under the debt category. Equity is nothing but that the company is asking money from the general public, and it raises money from all the retail investors who want to invest in the future of the company. Second is the debt. Debt is nothing but borrowings. Either a company can borrow a loan from a bank, or the second option is that it can issue bonds to individual bondholders or maybe other corporate bondholders, and basis this bond, they can get huge amount of money. So what is a bond? Bond is nothing but a piece of paper which is given to you and you invest in that bond. So basically, if I am a retail investor, I'll give money to that company. The company is going to give me that bond paper. I have that bond paper with me, and then after 5 years or 10 years, depending upon what is the maturity of that bond, I can get my entire money back, and even the interest rate on the bond, I'll receive that in fixed payments, let's say of 6 months or 1 year, depending upon what type of bond that is. So in simple terms, bond is nothing but a type of instrument where company can raise money in the general public. And again, if the company wants to borrow it from retail individuals, it can issue bonds in the public and people can just invest in that company and they can have the bond. So it's as good as I'm just investing in that company's future and the company's potential, and I'm getting a good rate of return. So that is the meaning of bond. The next important question is that who should ideally invest in bonds, or maybe what is the proportion which we should invest in bonds? So if you are a person who is maybe 20 or 25 years of age, then you have a lot of risk appetite as compared to people who are in their 60s. So what I generally recommend is that if you're a person having a lot of risk appetite, you should just invest 10% of your total portfolio in bonds, because this is a safe investment. You never know what can happen to equities or other asset classes, but with bonds, you're getting a fixed income after a particular period, and this income you can just use it basis your goals or your investment thesis in the near future. So basically, bond is for those who want to have a safe investment, a safe bet, and they don't want to take a lot of risk. Now, what I usually recommend is that I follow this 100 minus age rule. So if you're in your 20s, 100 minus 20, 80% of your portfolio should be invested in equities, and maybe 20% of your portfolio can be invested in bonds. So it might differ from person to person depending upon how much risk a person is willing to take. If you want a safe bet, then go for 20% allocation in bonds, because you can get good returns like 7 to 8% yield is there on bonds, or maybe 12-13% is also there if the credit rating is not that good. So it's a simple logic, right? Higher risk is higher return. So if the credit rating is bad, then the return is also going to be good. So I think you should personally invest 10 to 15% of your portfolio in bonds. And for those of you who are in the age of 60s or 65s, you should definitely invest maybe 60 to 70% of your portfolio in bonds, because that is a safe bet and you're going to get fixed returns after a point of time. Coming to one of the most important aspects, what are some of the factors you should consider before buying a bond of any company? So these are some of the factors which I usually consider before investing in any bond of any company. The first thing is the credit rating, which is very important. So basically there are various types of credit ratings. It begins from AAA, AA, A, BBB, BBB, B, C and D. So these are the various credit ratings which you're going to get. And I personally feel that you should invest in bonds having a credit rating of AA and above. It means that if a bond has a credit rating of, let's say, B or BBB, I usually don't invest in these kind of bonds because the risk is going to be higher. And I feel that you should also invest in those bonds which have a good credit rating. So of course it's a personal choice, but if you want to take more risk, there might be a possibility that the company might default, and you should only take those bonds where the possibility of default is low, that is, they have a good credit rating. The second aspect which I check is that whether the company has sufficient assets in order to pay off the liabilities. So my personal recommendation here is that if the company has liquid assets worth paying off 3 years of their liabilities in the future, then that is a very good company and that is going to repay its liabilities even if the company is not going to perform well, because they already have assets which are equivalent to their 3 years of liabilities. One of the most important ratios which I consider before investing in bonds is the interest coverage ratio. So interest coverage ratio tells me how much times the EBIT exceeds the interest amount. So higher the interest coverage ratio, the better it is for the company, because it shows that they have good profits in order to pay their interest. Some other factors which are very person specific are that you should consider these before investing in bonds. So first is the investment horizon. If you want your money to be invested for 5 years or 10 years, then you should select those kind of bonds having this maturity period. Second is whether they are secured or not. I always prefer to invest in secured bonds because even if the company defaults, then there's a possibility that you can get the money back basis the assets because of which it was secured. So if there are assets and if the company is bankrupt, then whatever money you get from the assets which are sold of the company, you can get that money back. And the last one is the yield to maturity, which is nothing but the rate of return which you're getting over the time horizon of, let's say, 5 years or 10 years. Higher the yield to maturity, better are the chances of investing, but beware of the credit risk which is involved, because higher the credit risk, higher the yield to maturity. Now talking about the equities valuation which are there right now, according to me, my personal view is that the equity valuations are overstretched as of now. The foreign institutional investors, FIIs, have been net selling their equities in the last financial year. So from April 2021 till date, the FIIs have been net selling their equities except the month of September, where the buying was also very small, which was very marginal. It was somewhere around $0.62 billion. But they have been net sellers in this entire financial year. The main reason is because of the Omicron variant, which is expected to come in Jan or February. Other reason is that US Fed has told that they are going to do rate hikes. So because of these rate hikes, investors are motivated to shift their money from India to US because of the higher interest rates which the US government is going to give to the investors. So these are some of the reasons that the FIs have been net selling their money in the Indian economy. I think the valuations are a little stretched as of now, but having said this, that you're not going to get very good returns in the next 1 year at least. My view is that in the coming year, you might get 9 to 10% returns in equities, but having said that, you'll get very good returns from FY24 onwards once the entire situation becomes normal and once the COVID is normalized. So my bet here is that the equities valuation are overstretched as of now, and I feel that the equity market is not going to perform the way it has performed in the last 2 years because of the COVID variant. So I think that the bond is a safe investment and a safe hedge if you want to allocate at least 10% of your portfolio, and you should definitely do that in order to have a hedge against inflation. So now the last part of the video, which is like one of the most important parts, how should I invest in the bond market? So I found a very good platform which is called as goldenpie.com. It's a very simple platform. So instead of me telling about the platform, let's just have a look at how the platform looks and how can you buy the bond using that platform. So this is the goldenpie.com platform which I was talking about. This is a very simple platform if you want to invest in bonds, okay? This is a very good platform for retail individuals. You have to simply log in using your Gmail ID and you have to click on the Discover Bond section. So all these bonds which are there in the market, the list of bonds would be available to you. Then let's take an example. We click on any of the bonds. So disclaimer is that I'm not giving any recommendation as stuff. I'm just explaining you how do you buy a bond using goldenpie.com. So this has a rating of AA. So as I told you that I usually prefer bonds having rating of AA or more. And this is the overview of the entire bond issue of Indiabulls Housing Finance Limited. So the minimum investment is 4,94,000. The yield is 12.43%, which is a good return as of today's situation. The maturity date is 5th June 2027 and the payment terms are also yearly. So all these details are given over here, and the cash flow details are also mentioned on the right hand side. So if you invest 4,94,000, this is the cash flow system. Like after every year you will get an interest of 53,250 plus the face value of the bond on maturity, which is rupees 5 lakh. So this is the interest, this is the cash flow, and the rating has been given over here, which is AA negative. So this is one of the most important factors which I usually consider before investing in any bond. The debt quality has been mentioned, whether it is a secured bond. So the bond is unsecured, that's why the yield is very high. So like there's no security, like if the company defaults, then you wouldn't get any money if any assets of the company are sold or not, because it's not secured as such. Then the seniority is mentioned. In case of default, the bondholders will be considered subordinate for payment. So tier 2 bonds are considered senior to tier 1 bonds. So of course, let's not get into technicality of what is tier 2 and tier 1, but in case of default, this will be considered subordinate for payment. So it will happen after the payment for tier 1 bonds have been done. And these are listed on exchange as well, so it cannot be converted on equity. So basically these are non-convertible debentures and these aren't convertible. So key highlights of the bonds have been given over here, like the coupon rate is mentioned, credit rating is mentioned, then the use of proceeds is also mentioned over here. So what is the need of raising this bond issue as such. And the best part is that you can compare your pre-tax return of bank deposit versus the bond return. So let's take an example. You have an FD in HDFC Bank. The rate is 5.5% pre-tax return and the pre-tax return on bond is 12.43%. So if you want to do it post-tax, you can get a comparison of the return between bank deposit and bond. So that's the reason I always tell you that of course FDs aren't a good bet if you want to hedge against inflation. So you should definitely try considering bonds. It's a safe bet in order to hedge against inflation, and other details have been given over here. So you can also compare the bonds of Indiabulls Housing Finance. There are other type of bonds as well. And if you want to invest, you have to click on invest and you can simply click on invest and invest in the bond. So you'll have to complete your KYC first, then you'll just have to submit your Aadhaar card details, etc. Then you'll have to choose the bond which is there, and simply you have to make the investment by paying the relevant amount using the UPI application. So this is a very simple process if you want to invest in any bond as such, and you can just learn about bond investing over here. So this is a blog section where all the new details of the bond market, if there's any NCD which is there, that is also discussed over here. So as I was telling you that there's this IPO also of bond which is coming. So if you don't have the capital of 4 lakh or 5 lakh, what you can do is you can invest a minimum amount of rupees 10,000 in bond IPOs. So bond IPOs are nothing but they are similar to the stock IPOs, right? So bond IPO is when there's an initial public offer of a bond and the minimum investment is as low as 10,000 rupees. So let's take an example of this Edelweiss bond. So all you have to do is you have to click here, and again same details like the previous ones are mentioned over here, and you have to select the IPO series. You have to enter the DMAT and UPI details. So basically the DMAT account which is there, if you're using Zerodha, then there's a DMAT account which is given. You can easily get the DMAT number from your Zerodha console section, and you have to accept the UPI payment mandate the way you do it for applying in an IPO, and finally you can get the bond units in your DMAT account. So this is a very simple process, and I think that this is one of the most user-friendly platforms if you want to invest in bonds. And having said this, that the bond market, it's only 2-3% of retail individuals they are investing in bonds. So 97-98% are still investing, like they are still issued to the corporate, and only 2-3% of the bond IPOs or the bond markets, they are issued to the retail individuals. So this is highly underpenetrated as of now, and I think applications like GoldenPie are definitely going to help us in order to increase our participation in the bond market. And if you want a safe hedge, you can definitely try out this application. So I've given the link in the description box. If you want to buy or invest in bonds, you can definitely click on the link given in the description box and use this platform for a safe investment. So I hope you like this video. If you like this video, share it with all your friends and subscribe to my channel so that I can create more finance videos for all of you. Thank you so much for watching this video. See you in the next video.